Hello, and welcome to another video from StageAnalysis.net. Today's video is the weekend update of the major US stock market indexes and indicators, where I'll go through the major US stock market indexes, plus the key market breadth indicators. The purpose of this weekly market breadth update is to help to determine where stocks will go next based on the combined signals of all the market breadth indicators, which is referred to in the stage analysis method as the weight of evidence. So today we're going to look at the bullish percent index, the new high, new lows, the advanced decline line indicators, and the percentage of stocks above their key moving averages, and the point and figure breakouts minus breakdown charts, plus the index charts, which I'll begin with. So obviously, as always, please like our videos and subscribe to the channel, and if you want to see when the videos have been updated. So let's begin. So starting tonight, we've got the S&P 500 on the left here. So this week the market had a strong thrust up in multiple indexes early in the week. It closed a little weak on the Friday with a lot of market breadth indicators showing some divergences. So I wanted to start with the index charts first, just to show that obviously the price action. So as you can see, it made a breakout attempt to new highs, but the S&P failed to close the week above the breakout level. The Dow Jones also pushed to new highs briefly before pulling back at the end of the week to close below. As you can see, the Dow Jones has been, its relative strength versus the S&P 500 has been declining since the October move began, obviously even since earlier in the year, since March time when it broke below its zero line here. The Nasdaq 100 was the only index, well, the Nasdaq stocks in general, not just the Nasdaq 100, but the Nasdaq stocks were the only area of the market that seemed to make it to new highs and actually close the week above. So as it's been outperforming, as we've said before, since early in the year, early in March, and continues to outperform. Small caps, on the other hand, had a pop back up again this week, but they failed to regain that breakout level again. They closed just above it with a very weak wick here. So looks like small caps had a very weak performance this week. Next, let's go on to major commodities charts. So we have the precious metals with gold. So gold pulled back strongly this week with the market move up, as it tends to have an inverse reaction to the market when there's risk on, risk off type trade. So as you can see, it pulled back to its breakout level, and then it managed to hold and managed to close the week back above. Even though it had a negative week, it still closed above the previous breakout level, so it remains on a stage 2 continuation at the moment. Its relative performance is roughly in line with the S&P 500 at the moment. The IEF, which is the 7 to 10 year Treasury bond ETF, which I like to follow, which is like an intermediate term Treasury, it pulled back below its stage 2 continuation breakout level this week, but did have a stronger close near the end of the week, so it could potentially go for the breakout again. Crude oil, as it traded around the breakdown level this week, had a small breakdown, then initial breakdown, and then actually managed to close the week just around the breakdown level. So still looking weak, potential for a stage 4 breakdown there. Copper had a rebound bounce, but didn't manage to follow through and ended up with a squat candle at the end of the week. As you can see, its relative performance remains weak. So again, potential for a stage 4 breakdown. Moving on. So next we've got the bullish percent indexes and the moving average breadth charts. So on the left here, we've got the NYSE bullish percent index. As you can see, the last 3 weeks it's traded down strongly, and this week it barely budged for the whole week, only minus 0.43% move, remains around the 62% level, so it's still in the bullish zone around its previous support level. But unlike the market, whereas the market price action was busting out to new highs, the bullish percent index has not followed and remains near the lows of this pullback. So it's a strong divergence in the major market compared to the S&P 500. If you look at the moving average breadth, this is the 200 day, this is the 150 day, and this is the 50 day. So the short-term chart had a small rebound here this week, moving back up to 54%. So it's in the neutral plus zone. Still on a bear confirmed. It's still on a bear signal low. We've got the medium-term 150-day moving average, which I like to use for the timing. Still, it had a pullback this week and bounced up to 60 and 64% now. So it still remains on a bear alert. And the MYA 200-day moving average, again, is at 64%, similar to the 150-day, remains on a bear alert. The Nasdaq Composite, similar to the NYSE, the rebound this week was pretty meager, only a 2% move back, and is nowhere near the highs, whereas the Nasdaq itself broke out to new highs. So Nasdaq itself is up at the top of the range, and the actual bullish percent breakouts are down here. So clearly it's a small number of stocks leading the move higher, so hence why it gives me pause and shows some warning signals that it could be a sucker's rally. So we got the 200-day moving average long term here. It rebounded back up above 55%, but again remains nowhere near the high. The 150-day is at 57%, and the 50-day is at 52%. All three weak bounces compared to the actual price action. So, next, we've got the NYSE advanced decline issues, which this is on the left here. We've got the cumulative advanced decline line. It failed to make a new high and pulled back at the end of the week here. The 10-day momentum index, which is the short term, as we said last week, it had reached a range where it normally has a bounce. We got the bounce, but it only just managed to pull back to its zero line, and obviously with the market moving to new highs again, this is a strong divergence showing here with three levels now. The 200-day momentum index, which is the long-term momentum index, it's mentioned in Stan Weinstein's book, which he actually refers to as the momentum index. As you can see, since October, it's been gradually putting in lower highs, and we're near. We've now got a breakdown level defined, and so a move below this next week would signal a sell signal in this indicator. And we've got the McLennan oscillator up here, similar to the momentum short-term index. The short-term McLennan oscillator bounced off of its normal lows and pulled back to the zero line and closed the week back below the zero line again. Similar divergence as we were seeing on that. Summation index remains on a sell signal here. The cumulative EMAs, the 10-day and the 30-day EMAs, have not had a crossover yet. Some of the other charts that I follow, the advanced decline volume and the Nasdaq advanced decline ones, a few of those have had crossovers, but I usually like to wait for a combined signal where all four of them have had signals, so like we got back in the start of the year in 2019. So we are definitely seeing some warning signs in the advanced decline line charts, but nothing major yet, but there is a possibility of a breakdown. Right, next we've got the new highs minus the new lows in the US market. We have, with the market making new highs, you would hope for this to also be strong. It had a reasonable week, but not brilliant. The cumulative line continues to thrust the new highs, but remains very extended from its 50-day moving average. In the short term, in the individual here, we've got the NYSE on the left and the Nasdaq on the right. So the grey is the new highs and the red is the new lows. So as you can see, the new highs are still outperforming. And what we look for with the new lows is for new lows to start spiking above the 100 level, and the new highs to fall below that at the same time. So at the moment, from this perspective, this remains on a bullish stance. Next, we've got my custom point and figure breakouts minus breakdowns in the US market. For this, the the red line is the 20-day moving average, and this is the cumulative. The black line is the cumulative line. So it had a small move back above, like 1 or 2 breakouts above the 20-day, but then fell back below on Friday, and again it's nowhere near the high, whereas the price action in the market is near the high. So it is on a risk-off signal currently and showing a divergence with the price action. Next, we've got the percentage of stocks above the 150-day moving average, which is ordered by strength. So, for example, the utility sector has 77% of its stocks above their 150-day moving average and is the strongest sector currently, and the energy sector has 24% of its stocks above the 150-day moving average and is the weakest sector currently. So we had reasonably strong moves up this week. Financials having the strongest move and being the biggest sector, that's a good thing. So positives in this one. Right, next let's look at this from a visual perspective. So from a visual perspective, the scale on the left is 0 to 100%, and on the right I've marked up some useful areas. So above 60% is bullish range, below 40% is the bearish range, and anywhere in the middle is a neutral range. So at the moment we're in the neutral plus and bullish range mostly. So as you can see, with the majority of sectors in that area, only energy is in the bearish, and utilities is the strongest bullish sector currently. But obviously, so it's a reasonably healthy market still. Okay, so where are we this week? So what I've noticed this week from all of the breadth charts with the weight of evidence is that there are a number of divergences showing. So we've got a number of warning signs in the market. This doesn't mean that the market's on a move into a sell signal by any means, but it does mean that obviously you should start to get a bit more cautious and maybe tighten up a little bit on stop losses, maybe cut some weaker stocks, but generally you just need to be a bit more cautious, as warning signals in the breadth, like the breadth is a leading indicator, not a lagging indicator like the price action in the indexes. So you tend to get early signals in the breadth, so warning signals can take sometimes a month or 2 to work out. So we may still go higher here, but the warning signals are telling you to start to get a bit more cautious and start to take notice, because clearly the rally is losing its momentum and we could be in for a stronger pullback maybe, but that's not guaranteed. But the warning signals just give us pause to be a bit more cautious. Okay, that's it for this week. So thanks for watching, and please subscribe to the channel and like the video below, and please go to stageanalysis.net to see regular updates and my daily stocks watch lists, and I'll see you on the next one.